Hi, I'm Andrea Graves, Director of Operations at the Retirement Education Center. And we want to thank you for tuning in to our Retirement Education Center Tuesday Tips. We created our Tuesday Tips in order to provide you with quick, simple ideas to help you reach your retirement goals. For additional concepts on how to maximize your retirement income, please subscribe to our YouTube channel and hit the notification bell to be notified when we upload new videos.
Hi, I'm Carson Graves, President and CEO of the Retirement Education Center, and I want to welcome you again to our Tuesday Tips. Now, what we are going to be discussing today real quickly are ways to avoid the IRS 10% early withdrawal penalty. Now, if you can avoid this, really onerous penalty, you're going to want to do it at all costs. Now, no matter what type of retirement account you have, you could be assessed a 10% early withdrawal penalty on it. But we are going to talk about ways in which you can avoid that. So definitely stay locked in. Millions of people actually have IRAs. And of course, at times there may be moments where you need to take money out of it before you're age 59 and a half for various reasons. But one of the ways that you can absolutely do this and not have to go under any other rules that they may have, like college education or buying a new home, any of the other stipulations, no matter who you are, you can always take money out of your IRA and avoid an early withdrawal penalty of 10% if you take what they call substantially equal periodic payments. Now, if you decide to take this route, you will be required to take payments from that IRA over a period of 5 years or until you reach the age of 59 and a half, whichever is later. So you really do have to get some really sound advice about this particular option, because if you are a 40-year-old person and want to take money out of your IRA, just imagine having to take that money out until age 59 and a half, almost 20 years. So it's either 5 years or until age 59 and a half, whichever is going to be later. Another option that people utilize for their retirement savings is a Roth IRA. Now, many people say, okay, I can get money in a Roth and I know I can take money out tax-free. But you still have a penalty that can be assessed if you're under the age of 59 and a half and you have not adhered to the 5-year rule. So one of the things that we always let people know when it comes to a Roth IRA, the way to avoid any type of penalty or taxes on your interest is just to take the contributions out only. So you would have put $3,000 in a Roth. If that money had grown to $4,000, well, and you're under the age of 59 and a half, simply just take out $3,000 and you will not be assessed a penalty on that Roth IRA, because contributions were put in after tax, and any of the dollars that have not grown inside of that Roth IRA you can take out without any stipulations whatsoever. Another way that you can avoid having that nasty 10% penalty added to your retirement distributions is by going under the rule of 55 or the rule of 50 if you are a qualified public safety employee. Now, with this rule here, one of the things you have to note is that you must have turned 55 when you leave your employer. If you do so, you also have to leave that account with said employer as well. If that is the case, you can actually take distributions out of your account and not be assessed that 10% early withdrawal penalty. As a matter of fact, this may be even a better option for you than actually taking the substantial equal periodic payments from an IRA, because you have much more control over these distributions. And last but not least, if you have a brokerage account, there are no IRS distribution rules. So you can simply have a brokerage account where you put as much money as you want to put into it, and whenever you need money, you can take money out of it. Obviously, the only thing that you may be subjected to are taxation on the interest, which may be capital gains taxes, but there will be no 10% early withdrawal penalty. So these are just some very simple, quick tips on how you can avoid a 10% penalty on your money. So I really do hope the information that I shared with you today will give you some insight on how you can avoid that onerous 10% penalty on your retirement dollars. Please understand that these videos are created for educational purposes only, and that you should always seek out your own financial advisor, your own tax advisor, and your own attorney regarding your personal situation. Also, if you are looking for a fiduciary financial advisor to help you with these types of complex financial matters, I highly recommend that you utilize the links that we have in our description below and go ahead and schedule a 1-hour free consultation with us today. If you have any questions or comments about the information in this video, please leave them in the comments section below. Also, do not forget to subscribe to our channel, like this video, and share with others.